Hello, welcome to my pre-class series of videos for Intermediate Financial Accounting 2. We're going to work on Chapter 18 today, and that's basically our deferred tax chapter. Pretty challenging chapter. We want to make sure we do incredibly well because a lot of times we'll see similar problems in FA4, or the final financial accounting course. So we're going to look at a couple different examples and work through these examples as always, and that will help you have a great class as I introduce this topic to you and we work through it. Let's get started. Example number 1. We have our information. When we're going to calculate our deferred tax journal entries, we're going to need to create a couple schedules. This is all about Schedule 1. Coming up with how do we create Schedule 1 to determine our taxable income. And then it'll lead into Schedule 2, allowing us to do all the journal entries. So how do you understand Schedule 1? So I'll cover some of the easier information, get a flow, get a feel for how to do Schedule 1, and that'll help you tremendously in class. So let's get started. Schedule number 1. How does Schedule number 1 work? Well, we start with our accounting income. And our goal is to figure out what our taxable income is. So we need to fill in our information here. Now, to do that, we're going to have two different types of differences. We're going to have permanent differences and we're going to have temporary or timing differences. And we're going to focus on creating Schedule 1 and putting that information in there. Let's focus on our permanent differences. What this is about is that we are trying to do a reconciliation, and we're creating a reconciliation between how accounting is calculated through basically general accepted accounting principles, IFRS for example, and tax methods. There's a big difference. A very simplistic way of looking at it is that through accounting, we use an accrual method. Through tax, we use a cash method. And we have different rules associated with different types of expenditures. So we have differences created between the two methods. And that's why we're creating a reconciliation here. The permanent differences. How I like to think about this is that one side, whether it's accounting or it's tax, is a yes, and the other side is the opposite, a no. So it's a permanent, it won't ever reverse. One side says yes, the other side says no. So we have to account for that. Now the nice thing about the permanent differences is we don't do journal entries for any of these. We just put them in here, helps us create and determine our taxable income number. That's it. So we'll start there. So we're told the net income is $2 million. So that is our starting point. Our accounting income was $2 million. Then we're told about a number of permanent differences. So for example, meals. Meals is a permanent difference. The issue with meals is that for businesses, they're going to claim 100% of their meal expenses. Tax only allows you to claim 50%. So therefore, what we have to do is we have to add back 50% of our meal expenditures, which is $7,500. Now here's where students get a little confused. Why are we adding something back? The reason why we're adding something back is the purpose behind this schedule is to come up with all the values that are different and have one number. That one number is what we're going to use to determine our current amount of taxes. So, of course, companies want this to be as high as possible because it makes their performance look great. But of course, for tax reasons, we want this to be as low as possible. So we got to take into consideration what is allowed, what is not allowed. So here, we've got to add back $7,500 because we have to pay taxes on that. We expensed $15,000 originally. We were only allowed to expense 50% of it for tax purposes. That's why it's being added back. Some other items here that we see that we have to take into consideration. Memberships, not allowed. So we're again adding that back. 5,000. Non-deductible fines. Well, it sounds pretty straightforward if you look at the first word there. Non-deductible, which means non-deductible for tax purposes. You're not allowed to use it to reduce your taxes. You can't have it as an expense. So a non-deductible fine would all have to be added back as well. Now, you can see these are all expenses, pretty straightforward, adding them back. So those are meals, memberships, fines. What about dividends? Dividends, this is not an expense, this is revenue. This is dividends received from other corporations. If we included the dividends in here, which we did, and then we paid taxes on that, that would create a double taxation system. Because the company paying us dividends pays us the dividends with their after-tax dollars. And then if we paid taxes on the dividends we had received, that's double taxation. We want to avoid that. So here's a situation with the dividends where we get to reduce the value, reduce, at the end of the day, the taxable income, because we don't want to have double taxation. Now we're down to our last two here, warranty expenses and then warranty cash paid. This is a situation that's a timing temporary difference, which means that if you give this enough time, this will equal out if it's done perfectly. So we make an estimate of what our expenses are. Let's say our expenses will be $300,000. Give it enough time, if we're accurate, we will pay out warranty expenses of $300,000. But there's going to be timing differences because we recognize the expense when we make the sale, but the actual paying out of those expenses will be delayed. So tax uses a cash method. Accounting uses the matching principle. Recognize the estimated expense at the time you're incurring the revenue. So it creates a timing difference. For this one, and a method that I've shown in class many times, and I'll explain it to you, there's a pretty logical way and a pretty good way of memorizing this. The accounting expenses, you're not allowed to use. So you add those back. So you add back the warranty expenses that you accrue. What are you allowed to subtract out? Subtract out the cash that you paid. So the warranty cash that you paid, $30,000. Subtract that out. We now have our taxable income number. And you can see that it's a little higher than our accounting income number. That's natural. It usually is. We're going to usually have to incur a little bit higher types of numbers in here and pay a little bit more taxes on that. That is natural because of the cash basis, and cash is usually delayed versus the accrual method. So this is a good starting point for you understanding Schedule 1. We'll do more examples of this in class, and this will allow us to have a smoother transition into Schedule 2, which is a little bit more challenging, but that's what class is for. Let's move on to our second example. When we finish our main topic in deferred taxes, we're going to get into a smaller topic about what to do with tax losses. Our first topic was about the profits and having great years. But what do we do when we have a bad year? How does that work? And the fairness of taxes. How does the fairness of taxes affect our taxes paid and our taxes possibly refunded to us? Well, here's our first year, 2015. We have a profit. We've got a tax rate. What would be the journal entry? Pretty straightforward. Current income taxes expense would be 25% times 100,000, $25,000. And current income taxes payable, you could put cash if you wanted, $25,000. Now, in 2016, we suffer a loss. Does that mean that we get no benefit at all from that loss? It's just purely a loss, we're out of luck, that's it? The answer is no. The tax system works really nicely for companies in a sense that over a period of time, some going back, definitely going forward much more, we can recoup some taxes paid to help us out. So you can see here is that we have a loss of $80,000. So in this very simple example, we could go back to 2015 and get some of those taxes back that we paid to help us out. The key thing, and why I'm going through this example with you, is that if we're going to take this $80,000 backwards, we're going to recover that amount at the taxes that we paid in previous years. So 25% is the tax rate that will apply to this $80,000, not the 30. So this is key for you to understand this, because we'll get into much more detailed examples in class. Don't forget this fact. So when we're going backwards, it's the tax rates that were in effect at that time. So in this case, we would have current income tax refund receivable, and it's $80,000 times 25%. That'll be $20,000. And this will be a current income tax benefit of $20,000. So again, the key thing I want you to focus on here is the tax rate that was in effect going backwards is what we're going to use, the 25%. So I hope these two examples will help you. Have a great class. Thank you.